Good morning, everyone. I hope you are doing well, that the plenary was interesting. So now for this session, we will turn to retail debt programs. Retail debt programs are a very interesting topic, I think, because they have a very different history. It's still debated whether the oldest retail program was created in the 15th or the 16th century in Europe. We'll probably find an older retail program created even earlier in other regions. But they have a long history in many cases. And at the same time, in some countries, they are just created right now. And you have countries who just created last year or are working on creating their own debt retail programs. So very diverse history. And it's reflected also by the fact that they are very, very different in terms of their products, their modalities, their objectives, their systems. In terms of products, in some cases, retail investors, households, they can access exactly the same products, the same bonds, as the wholesale investors. Other cases, countries have elaborated specific products dedicated to retail investors. Could be saving bonds, could be even more exotic products like lottery bonds. That's a first element of differentiation in many cases. The objectives as well. The main objective is, of course, to get funding for the government at a low cost. But it's not the only objective. In some countries, there is an objective of financial education of the population. In others, there is the objective of providing the population, maybe the least educated, people in the countryside with fewer access to the banking system, to provide them with an option to get their savings somewhere safe, secure, with a decent rate of return. And the way those objectives are mixed is very important in the architecture of the retail debt programs in those countries. Even in terms of modalities, the older systems, usually they relied on the physical networks of offices. It could be in the public sector, it could be the post offices, it could be the private sector, agreements with the banks, with the private banks to provide the product, or it could be a dedicated retail system. You could have the debt management office in charge of the retail program. It could be a different ministerial department, could be a different entity, it could be a public agency. It's the case in the UK, for example. And the modality to access the retail investors have evolved as well with new technology. So from physical network of offices, the programs moved to telephone. They moved to direct payment on the salaries in some cases. Of course, with the internet revolution, it has been another way, usually cheaper, to access retail investors. And now you have programs developed or being developed using web app, using even mobile phone. Kenya has been working on a program to offer through mobile phone government bonds to retail investors. And the options, modalities are also way different. In some cases, the government is offering a free option for the investor to pay back earlier the debt if they want to, if they need, if they have a reason, if they need the money. In other cases, you have to go through the stock exchange, you have to go through a bank, and you have to pay, or you have to, you are offered the usual market price for the bond. Last point is the cost. In most of the cases, the outstanding debt, retail debt, is limited, is not that significant compared to the total government debt, which means that the cost for every dollar collected through retail can be important, can be significant, especially if you have heavy investments have been made to install the systems, to develop the network. New technologies are definitely a way to lower the cost, and for those who create programs right now, it's probably a cheap option, or at least a cheaper option compared to options in the past. This cost is important also in the context of low interest rates. It's more difficult to charge an administrative fees of a few bips when the interest rate and the coupon is 50 bips or 1% compared to 5 or 6% in other cases. So this really is a way to describe a very differentiated landscape. And today we have the honor of having 4 speakers, distinguished speakers from 4 different regions, and with 4 very different retail programs who will present their programs and the challenges and the new ideas they may have to even develop further the program, and they will respond to your question. I will suggest that each speaker present the program and will collect your questions at the end after the different speakers have spoken. So I will call on first the first speaker, Mr. Suwit Rojana Vanic, the Director General of Public Debt Management Office of Thailand. I don't need to present Suwit because all of you know him now from the plenary one yesterday. So Suwit, please.
Good morning, everyone, and thank you so much for let me recommend. I have to say that let me recommend you to do some kind of saving bonds for your people. Okay. We had a long experiences for the saving bonds. Let me say that before the crisis, Thailand had financial crisis before. At that time, one way that we mobilize funds from our people. We just announced that the country has crisis, so we offer saving bond to them. And very successful, 29% of the portion is saving bond of the government debt. But when the time passed by, saving bond is less important. Because what? Because the government has many other instruments to mobilize funds with less expensive than saving bond. For saving bond, we pay to the people. So we try to add up some in interest in order to let them know that we appreciate their kindness to help us. You may notice a portion of the saving bond, the yellow one, you see. Household and non-profit in the government debt is now very small. This is the challenges of the saving bond issues in last 10 years. From 2007 and to fiscal year 2016, in the old days, we try to educate them like if you are a salary person, you just purchase saving bond every end of the month. It will be some small issue monthly. And then that one doesn't work. They prefer to purchase stock in order to purchase the saving bond because that's how the equity market get more return. But we still confirm to them that this is zero risk-free document. So please be proud to be creditor to the government. And then we issued a large amount in 2009 and larger in 2010. And then change to some small, some large. We learn from those few years, and then we improve more and more. Every time we would like to issue the saving bond, we have to discuss with the minister also that how much interest rate that we would like to offer. We look at the yield curve first, and then we add something like the tax plus into the saving bond interest rate in order to let them feel very satisfaction. At least they can get something more than inflation and without tax. I mean, in reality, they have to be deducted by tax 15%, but we add that into the interest rate. So they feel very comfortable with our saving bonds. And most of the people, I mean, the medium and the rich people, they prefer our saving bond because, first of all, it's higher than saving rate in the commercial bank. Second, they have a large amount of money, so they prefer something very safe for them. So when we look in deep detail of our customer, most of them are very wealthy. So we try to change our process. We offer to other people also, let them purchase with a limit amount per transaction. If they would like to invest in very large amount, they have to go from bank to bank in order to get a maximum amount that they would like to. But we would like to educate our people to save in saving bond. That is another process that we would like to tell them. You may notice that domestic bond market has developed rapidly and efficiently. The government has more options to borrow money, as I told you already. Benchmark bond and other innovation bonds have lower borrowing costs than saving bond because it's bidding. For bidding, we can get a very low rate. For saving bond, we have to add up. So you may notice that for saving bond is a bit higher than other bonds because it just government offer to their people. And we have more competitors now. The government funding tools are as follows, something like benchmark bond, 5 year, 3 years, 7 years, 10 years, up to 50 years. And saving bond is one item only, and inflation linked bond. This is one of the most famous from Thai because it covers inflation rate. And we have amortized bond, and we have bank loan and treasury bill and promissory note. 60% is a major government funding instrument on the benchmark bond, start from 5 to 50 years. And investor has more options, asset allocation, investment knowledge, and growing of alternative investment in the market, like derivative, commodities, mutual fund, real estate, etc. For mutual fund, they have a very, very good invest broker and whatever. They can invest here and there, both domestic and in foreign country, so they can get higher yield for their customer. And saving bond as a government funding instrument, we still keep that in order to maintain our customer, and we would like to appreciate all the people who purchase our saving bond. And before the crisis, the liquid bond market and unreliable yield curve main instrument for government fundraising. But after the crisis, it's getting better and better. Saving bond and other government funding tools, I have to say that it's high cost because we add interest and demand of the investor. Main investor in the government bond are institutional investor, lower and relative return compared to other investment, equity, commodity, real estate. For Thai stock exchange market, we offer a very high return, but you have to select very good stock, okay? And current saving bond position, we have to say that it supports government policy, saving bond society. And for retail investor, especially early risk-free instrument, we can guarantee that we keep paying interest and principal and maintain the proportion of government funding in the future, limit the time period and large amount. As I mentioned already, someone cannot purchase in a huge amount. We would like to save it for others. And distribution channel. Most of them prefer to go to the bank counter. We ask commercial bank to be our agent to sell the saving bond for us. And we offer them, they can do through automatic teller machine, the ATM machine, and internet banking also. But most of them go to the bank counter because they purchase in a large amount. They prefer to do transaction with people. We would like them to use the machine, but not so easy. Now we have to try hard, try more. And now we change from the paper, the saving bond paper, into electronic already. All the customer who purchase a saving bond still get the bond book, like the passbook of the saving account, but that one is a passbook for the saving bond. issue for them. At least they have something to touch and look at the figure. But in reality, the amount has been registered by the Bank of Thailand, the central bank, and interest and principal will pay to them every 6 months. And when the time come close for the end of the period, the Bank of Thailand will transfer the total amount of the bonds to their own account. One thing that we have difficulty is someone, they close the account. So it's difficult for us to find who is going to receive this kind of money. We allow them to tell us and register to us again. If they accidentally close the account, we just responsible for all of the customer. In the future, we are planning to make it happen, widening, deepening, and diagonal, extending the selling period. Sometimes we sell 3 months, 4 months, 6 months. We would like to have the whole year for the member to purchase a saving one whenever they feel free. Just go to purchase. And we would like to increasing the number of distribution channel and expand the retail investor base to non-profit entity and working age. Something had happened in our market, very, very successful. We offer to senior citizen for the first 2-3 days for the saving bond. People who are more than 60 years old can purchase the saving bond first, and the rest after 3 days, we allow anybody to purchase it, because we think that senior citizen should get something that is benefit to them. And we would like to expand the bond type regarding to the investor preference, and we the whole system development, and we would like to do something as US also, like the Treasury Direct, in order to make it more convenient. Thank you so much.
Thank you very much. Thank you very much, Soit. Thank you for your very comprehensive presentation. I noted two points that could be of interest later on the discussions. In the discussion, one was the competition from saving products offered by the banks. You said that your product is very competitive and you offered higher rates. So that's something that could be an interesting point to discuss, especially in the context of the implementation of Basel III, where household deposits are a very important and interesting liability funding source for private banks. And the other point is the population you are targeting, and the fact that you are targeting the older retired people, which is also an interesting dimension. But now I'll turn to our second speaker, José Franco Moraes, the Undersecretary of Public Debt at the National Treasury of Brazil.
Okay, good morning, everyone. Thank you, Sebastian, for the invitation. It's a pleasure being here. Well, what is the? I'm just thinking about our panel here. I mean, are retail markets still relevant? I mean, in order to answer that, I mean, let's just have a look at the market as a whole. You know, what's the normal functioning of the markets? I mean, usually we collect money from retail investors through institutional investors. I mean, like mutual funds, pension funds, and so on. Usually, those are the main buyers of debt. You know, why trying to reach the retail investors directly, you know, without using the intermediaries? There might be some reason for that. Usually, when you talk about the retail market, I mean, there's a lot of people. You know, whenever we see, we run an auction, we see like, at least in Brazil, we sell monthly an average of 10 or 15 billion dollars equivalent. Okay, for any auction, we can see the like 30, 40 participants, you know, which buys a lot of money. when we talk about retail investors, we talk about thousands and thousands of people, all right, with very, very small tickets. So, I mean, does it pay off? I mean, in order to develop a retail program, I mean, it must have a purpose. And usually, I mean, I'm not saying that it's going to be for every country, but usually the purpose is not just being financed, you know, because you get your funds through institutional investors, which is more related to market development. Okay, well, let's go to the case of Brazil. Well, talk about the purpose. What is the purpose of developing the retail market for bonds in Brazil? I guess the same one for as far as I understood from the Thailand case. I mean, to incentivize savings. You know, Brazil, as opposed to China, for instance, just to name one of the BRICS. I mean, China is trying to change their growth model from investment to consumption, while Brazil is trying to do the opposite. I mean, we're trying to change our model from consumption to investment. But in order to have investment, you need savings, you know, and usually Brazilians are not good savers, you know. And talking about the intertemporal consumption, Brazilians on average prefer to consume today rather than tomorrow. Okay, so I mean, this why I'm saying this. I mean, the retail program for bonds in Brazil. The main reason is to educate people. You know, to make them understand that, I mean, it pays off to save money. You know, to postpone consumption for tomorrow rather than for today. Well, let's go to the presentation. Well, I'm going direct to the mechanics of our program. It was created back in 2002. It is 100% internet based. There are no papers. I mean, you must have access to internet in order to buy the bonds. Another important aspect. I mean. We don't need to develop market infrastructure in order to foster this program. So the strategy was to use the market infrastructure, okay? But in order to do this, we must have partners. So the main partner in the case of Brazil is the stock exchange. The stock exchange is a kind of custodian as well. Okay, and the distribution channels are through broker-dealers. So we have the stock exchange and many broker-dealers. Why do they support the program? I mean, they get money out of that. Okay, so they charge a fee, not only the stock exchange, but also the brokers. And they see value on that. Actually, some brokers charge zero fee. And why do they do this? Because they see some positive externality. You know, whenever an investor enrolls himself to buy a bond, you know, at some point he could buy stocks as well through the broker dealers. So I mean, they do that for business purposes. So that is very simple. The mechanics, you know, once it is in place, it works very well, I would say. What are the advantages of this model? Low cost. I mean, as I said before, we just use the existing infrastructure, technology, human and physical resources. Okay, so the marginal cost is very, very low. Greater capillarity. We have multiple agents that are distributing government bonds, and some performance gain, since I mean there are competition among banks and brokers, which stimulates improvements of procedures, service, and technology. Here it is important to mention that I mean the banks themselves are not large supporters of the program. And there's one reason, very, very simple. I mean, the banking industry in Brazil is very concentrated. The 4 or 5 largest banks have a market share as large as 8%. So, and so is for the mutual fund industry. I mean, each bank has its own mutual fund, you know, which compete with our product, which is called the direct treasury. So the banks prefer to sell their own products rather than the ones from the treasury. And even public banks like Banco do Brasil, you know, which is a public bank. I mean, they do not like to actually sell our products. But anyway, it has it's good to have this product. I mean, it has a lot of visibility. You know, people actually once they start buying the bonds, they get used to it, and they get curious, and they are willing to be more and more educated on this. The bonds that we sell through the internet are basically the same ones that any investor can buy. Okay, except that the minimum ticket is something like $15 or $20 equivalent. Okay, but the bond is the same. How we came up with this? The minimum price for for a treasury bill, for instance, is around let's say $300 equivalent. Okay, so in order to make it more accessible for people, so for this specific program we sell fractions of bonds. So in terms of quantity, they can buy any multiple of 0.2. I mean, they can buy 20% of one bond, 40%, 6%, and so on. So we did that in order to make the program more accessible for the lower income people. Well, of course, I mean, the system is IT intensive. You know, we are debt managers. I mean, we do not have capabilities or the resources in order to invest on IT. So that's why we actually need to have partnerships, you know. So the stock exchange is the main developer of the system and so on. Here there are some. I'm not going to show this, but anyway, we can see on the slide here. The last one is our program. This one here, which is called the Tesouro Direto, Direct Treasury. You know, as you can see from the last column, I mean, the size is very small compared to the industry, and also compared to the public debt outstanding amount. The share is less than 1%. What are our potential clients? Let's say. I mean, after we learned that with during all this period. Okay, of course, I mean there is a learning curve. When we launched the program, in 2002, we didn't have exactly an idea of what would be the proposal. What would be our main clients. But we learned during this period. I mean, potential clients are the ones who seek convenience. They do have a higher level of education. Since they have to choose the main which bond to buy. I mean, there are basically three different types of bonds: fixed rate bonds, floaters, and linkers. Okay, and for the linkers, there is one which was specific for this program, which are zero coupon linkers. We got feedback from investors that this program was particularly useful for pension fund purpose, let's say. So people want to save money for their retirement. Okay, and whenever they receive coupon, I mean, most of them do not like that. Because they just receive the coupon and they have to reinvest. Sometimes the coupon is very low, so they rather not to receive any coupon and just be paid at the end of the maturity. We do not sell this specific bond for institutional investors because they have no appetite, and of course duration is much larger. It's much longer, the duration. So the bond is much more volatile. And one characteristic of the investors of this program is that they are more willing to take volatility. You know, unlike most of the Brazilian investors, I mean, Brazilian investors can't stand any kind of volatility. You know, they can't stand any loss on capital. Okay, but not for this program here. They're not the ones who actually keep seeing the balance every day. Okay, they understand and they use this for also for pension fund purpose. Class A and B, I mean, although we make the program accessible, you know, for lower income class, usually, I mean, there are other products much simpler that could be used for this type of investors. In terms of the age, young people, you know, between 26 and 39 years, those are the main buyers of the bonds through the internet, and workers in the beginning of their career. I mean, it's it's quite plausible. I mean, young people have more access to, you know, to facilities, to technologies, and so on. Okay, another point which is interesting. It's part also of the learning curve. You know, we are debt managers. You know, we are used to run auctions. Okay, we do have a IR unit, but the IR unit deals with rating agencies, deal with institutional investors. In this case here, I mean, we are competing with the market, you know, with other products, with banks who have more capabilities, you know, and can actually have more resources to invest on advertisement and so on. In the past, or in the beginning, the name of their bonds were the same, you know. I mean, which are basic letters, like the Treasury bills we call LTN. LTN, I mean, for the retail investor, it means nothing. You know, a linker is NTNB. It means nothing for them. So after, you know, we had a marketing consultant, okay, for financial products, and she said, well, why do you don't just put some more, you know, reasonable names, like inflation plus or whatever? And we did it. It was the result was very good. Another point, daily liquidity. In the beginning, the Treasury was committed to buy the bonds only once per week, you know. But Brazilian investors are pretty much used with daily liquidity. So we decided, you know, to buy back, to repurchase the bonds on a daily basis. No problem with that. Of course, I mean, there is there could be some risk, you know, whenever the share of this program was higher, you know. But as I said before, I mean, it represents less than 1% of the outstanding amount of public debt. I mean, so even if all the investors would come in the same day to sell the bonds to the Treasury, there would be no problem. Another tool which was interesting, this financial advisor, you know, is everything online. It's like a system, you know. So this program asks the person, what's the purpose of your saving? You know, the idea is for the system to determine what's the profile of the investor. You know, is she willing to take more risk or to take less risk, in order to help them to choose which bond to buy and the tenor. Another experience that you had, I mean, investors prefer to have less choices. You know, in the beginning we had like 15 choices for them. They don't like this, you know. So just reduce the number of possibilities is better for them. What was the result? I mean, those are the waves that we call. Those are improvements in the system. The first wave was already in place. Okay, I will show what was the result, the outcome. Those are the sales of this program. So after the launch of the first wave of improvements, the sales increased a lot. And it was good on one side, but on the other side it was one disadvantage. I mean, we at the Treasury, we were not prepared for that. You know, because I said before, I mean, we are dealing with people, with thousands and thousands of people. So once, I mean, the program grow, the questions grow as well. You know, so I mean, we didn't have the human resources in order to do this. We had, for instance, one channel in which our own team were answering emails or questions and so on. But at some point, it became so large that we just outsourced that for the exchange. I mean, we don't have the resources to do this. What are the new waves? Another tool, which is a simulator, which is a very complex one, and it will compare, you know, the returns with other products. We will make available scenarios for inflation, for interest rates, for exchange rate, and so on, so that it will help the investor to actually decide which bond to buy. And the third wave, which is in pipeline as well, is an APP. You know, I mean, so investors will be able to buy the bond through their smartphone. Well, this is the experience of Brazil. I will stop here. Just before I actually finish my presentation, I just want to mention another way that we are working on in order to attract the retail investors, which is the ETF. I mean, we talked this in more than one session, even this morning and yesterday. You know, an ETF is an exchange trade fund. So the idea is to create a fund, you know, with a basket of bonds, and investors will not buy the bonds, but they will buy the index. You know, it's part of the capital market development. Here in the U.S., it's very popular for stocks. You know, we believe that in Brazil it can become popular as well, because fixed income is very popular in Brazil. So we expect the ETF to be very popular as well. And this ETF is an initiative, partnership with the World Bank, you know, in which the Treasury will actually issue a basket of bonds for the manager. You know, we are right now in the process of selecting the manager who will actually launch the ETF. Well, I guess my time is over, and I'll be very happy, you know, to answer any question you might have. Thank you.
Thank you very much, Franco. You pointed to one of the usual issues with retail program, which is the fact that retail investors are very adverse to any loss of capital. And this can be an issue when you offer them the possibility to get out of their position at market price, which could be below par. So this is one of the typical issues faced by retail debt programs. And the other is, of course, the price of success, of being too successful, and the fact that sometimes having 1 million registered users,
almost 1 million, yeah.
Almost,
we're about to reach it this year.
So you need to be prepared to being too successful. Now I will turn to our third speaker, György Barcsa, the Chief Executive Officer of AKK, the Government Debt Management Agency of Hungary.
Thank you very much. Well, a warm welcome from Hungary, because this is really a distinguished guest here. So that I was invited to share our experience about the retail program. And I would like first to mention you that the idea came not from a kind of portfolio approach, which we usually, I think, adopt for debt management, but from a macroeconomic approach. That if you are a country and then generally the corporate sector, in terms of a flow of funds, the corporate sector is borrowing. The government is borrowing. If the household is not saving enough, then you will have then the country will accumulate foreign debt. And to solve this equation, basically the country needs to have enough domestic savings, which is usually the household sector, to cover the financing need of the corporate sector and the government sector. If this is not the case, then either the country should have low investments and then low growth, or a very small budget deficit or even a surplus, which is politically usually very difficult to achieve. So our approach is generally kind of a macroeconomic approach and not so much a portfolio approach. Also in a way that we think that if we build a public debt portfolio at a low risk, and we are able to decrease the overall risk of the portfolio, then we can get a reward from the market in terms of cheaper financing. So very often when we have the portfolio approach, we are talking about risk versus cost. If you lengthen the maturity, you will borrow at a higher cost, but you will have lower risk and so on. But I think generally this is the case if in some instances, and especially if you are thinking only about mathematical models, but in practice, in reality, if you have a safe portfolio overall, you will have cheaper financing. And this is what we wanted to achieve, that we are trying to build different markets. And maybe one market is more expensive than the other, but the overall cost, currently we are overall financing the government debt at a 2% interest rate, which is historically the lowest. And I think it's quite acceptable, especially for the case of Hungary. So this was the starting point, and then as I mentioned in the plenary session, that retail program, because this is restricted only for domestic residents, for investors, can guarantee you that your public debt increase will not generate external debt. And I think this is the only way you can do that. Secondly, if you diversify and you decrease the supply on the wholesale market, it can have advantages, because in case of Hungary, on the wholesale market, local debt, I'm talking only about local debt, foreign bond holdings were quite high, like 20% or 25% of total local debt. And some fund managers came to Hungary and they said that based on their benchmark, global bond benchmark, the share they have to hold in local currency bonds is not as high as the actual holding of foreigners. So simply because of a lack of enough domestic ownership of the local debt, actually foreign investors were forced to all the time overweight Hungary relative to the benchmark. And this created a situation that the Hungarian local market became very volatile, and the compensation for the volatility, basically to compensate for the continuous need for an overweight rating of Hungary in the portfolio of foreigners, yields had to be very high, and the cost was extremely high. I mean, the yields were around 6, 7, or 8%, and let's say interest rate expenditure in the budget was 4-5% of GDP, which is huge. I mean, 10% of all budget expenditures went on interest costs. So we wanted to restructure basically the whole public debt portfolio. So the idea is to restructure, and this is what we could. One part which we could do is to establish a retail program, and in 5 years' time it was almost non-existent, like 2% of local debt, and now, as I mentioned, it's 25% of public debt. And this is what we have achieved over 5 years, and the program is running so fast that I will always remember to the aforementioned words that it can be too successful. Because it's very difficult to predict the demand you can have on the market. Sometimes maybe not so much, and then it starts to grow, and even you decrease the yield, and it remains very, very strong. And then, okay, what do we do with too much money? We can have maybe rising public debt. Is it how can we stop? If we stop it, we cut interest rates substantially from one day to another, and it stops. Then we have another problem that we started this, and then we have to stop it. So. And this is, I think, the biggest risk for us, because it's a new thing and unprecedented in Hungary, how to manage 25% retail debt. This is, I think, the major risk for us. Regarding the structure, let me stop if it's not that interesting, but I will just summarize the structure that we have. That basically the network is consisting of 8 big banks and some additional brokerages, but 8 big banks are in Hungary, and they have roughly 90% market share. And we have the so-called Treasury network, which is fully a government-owned Treasury network, which is also submitting the money or transferring the money to citizens. I mean, subsidies and family payments and things like that. And these Treasury network offices, they are all around the country, basically in every big cities. So, and that's the second leg, and the third is the post office, which is in every small cities. So we are able to cover generally all type of investors. Older investors in villages and so on, they go mostly to the post office. And rich people, actually, they go to the Treasury network, because at the Treasury there is no fee for maintaining your account. So simply there is no monthly fee, or even some kind of additional fee for the account. It's completely free, and this is a big advantage. So very rich people in Hungary with a lot of bonds, they actually hold the bonds on their Treasury account and not at banks. But this is just a sign that maybe some kind of an interesting story. But so these are the 3 channels that we are selling. We are paying 1% fee, as I mentioned, which makes this, the product maybe expensive. But as I mentioned, if you look at the overall cost of that financing, it's probably one market where we pay higher, and on the wholesale market we are able to finance ourselves cheaper. We have 11 products. The most popular ones are the 1 year and the 6 months bills, because probably they are competitive products to closest competitors to the bank deposits. And now it is not just new savings which we see as an inflow, but also kind of a restructuring, because as I mentioned, bank deposit rates are so low that people are transferring money from banks into government securities. And I think here it's an interesting point from also a macroeconomic point of view, that when at the time when interest rates are 0 or even negative and so on, can and should the government offer a retail market program with a positive yield. Because I mean, it's an artificial thing, so we can offer positive yield even in real terms. But what does it make sense? And then the whole issue becomes a very complex macroeconomic issue, which you can try to model, but it's very difficult. But in case of Hungary, what is important, that generally we pay the interest rate for domestic households and not for foreign investors. We are not against them, but if we pay, let's say, just 1% interest rate on an IMF loan, the country's GNI will be 1% lower. If I pay the interest rate for the households, maybe 3%, the country's GNI will not change. And this 3% interest rate could be higher, but it becomes savings, or it becomes investments, or it becomes consumption. And this was the first critical point that we reached when we started. People said that, the 2008 IMF loan was so cheap, this retail program is expensive. Yes, it was at the beginning. But now, as I mentioned, we are financing ourselves cheaper than the IMF EU loan interest rate was at that time. So now this type of criticism disappeared. And it's good also for the banks, because generally there is not much lending in Hungary. A little bit recovering, but not much. There is no capital requirement for this service. They have a liquidity surplus at the central bank because Hungary used to have a fixed exchange rate and a lot of money supply was created, and the stabilization deposit appeared in the central bank balance sheet, and this is where the banks can now have liquidity, so there is no crowding out effect. And this is why actually bankers, they are supporting the idea, and they are not threatening me actually to resign or something like that. You never know. Maybe we'll see next year. For customers, it's also partly because it's maybe an emerging market situation that we had some scandals, brokerages, financial companies went bankrupt and so on, and also people are a little bit disillusioned from mutual funds and very well-sounding but complex and maybe overall at the end not very positive return yielding financial products. So they more like the government securities now, probably just similar to Brazil, that they know the return ex ante, so they don't have to be a financial professional and look at the value of their investment every day and so on. They can be a little bit lazy and they can invest the money into a one-year bill and they don't have to care about it for a year, and they know that they are going to get the yield at the end of the term and the end at maturity. There is also 100% government guarantee both for the capital and the interest rate, of course, which is better than for bank deposits, where there is a limit, 100,000 euro for bank deposits. And as I mentioned, there is no fee generally for transactions like transferring money inside and outside of the Treasury network and so on. There is some fee. If somebody wants to sell the retail security, it has to pay 2% fee. So there is a very big cost if somebody wants to sell the retail security. So 2%, when the, let's say, annual yield is 2%, it is a costly thing. So people do not really sell the securities before maturity, and this is what makes it I think a safe product. Even though the duration is relatively short, I think it is not fully comparable to a wholesale 10-year bond, because the wholesale 10-year bond is bought by the mutual fund, which is basically a one-day investment. And the mutual fund looks like to have a 10-year bond in the portfolio, but it's basically a one-day investment, transferring the maturity from one day into a 10-year. But that's a risk, and somebody has to have that risk, and if there is a risk, there has to be a cost. And the cost is when you have a bond market collapse, because then the market stops working. And this is what is almost not possible for the retail market. So generally, I think these are the main characteristics. For the future, we plan to improve on the advertisement and marketing side. We would like to compete with the banks at the same level in terms of advertisement. Actually, I think we could be better. In terms of the products, we have 11 products, as I mentioned. The 6 months and the 1-year T-bills are the most popular ones, and the second most popular ones are the inflation-linked ones, because Hungary has a traditionally high or moderately high inflations, and we have 3-year and 5-year bonds with inflation plus 2.5 plus 3%, so around 2.5–3% real return, and this is attractive for the 3-year and 5-year tenor. And then we have 4-year and 6-year and 10-year bonds with a variable rate, which is linked to the average interest rate of the 12 months T-bill plus a premium. But this is such a complex mechanism to set the actual coupon that it is not really attractive. So we are trying to make it very, very attractive. This is the highest yielding product. This money market rate-linked bonds, but people don't really like that. We would like to have some kind of lottery bond, which is the case in Sweden, for example, but according to EU and Hungarian laws, it is not really possible. But in the case of Hungary, we think it would be very, very popular because Hungarians like to gamble in some way. So that really it's my personal preference to have this, but it for me takes a lot of lobbying to have kind of law change and things like that. But I mean, if you, my simple idea is to offer 100% return for every 100 number of bonds. So no return for 99 bonds and 100% return for the next one, and then no return. And I think this could be when nominal rates are basically zero. So people are holding their cash on simple current accounts and even not putting them into bank deposits. Such a product could be very popular. And for me as a debt manager, the cost is just 1%. But as mentioned, this is not yet possible. We discussed the ETF product, but this is not much a retail thing. In terms of the service, everything in the banks and the Treasury network, everything is, I mean, full service, so there is no distinction. You can make the same transaction like making a bank deposit as buying a retail government security. So everything is in the banks, internet systems, web-based systems, or if you go to a branch, you can do the same, and this is the same for the Treasury network. The Treasury network fortunately is quite advanced in terms of IT, and they have a very good website and so on. We need a lot of, I think now we need a lot of work we have to put into to teach the people, because actually people think that government securities are investments only for the rich. So this is the number one challenge now we face, that we have to make advertisements that government securities are for all people and not just for the rich. And then we have to explain them that we have a lot of products, and then we have to explain that where and how can they buy that. Thank you very much for your attention. That was all.
Thank you, Georgi, for the presentation of a very successful retail debt program and the insight on the reason to better monitor the foreign and domestic ownership of debt. And good luck with your future career as a casino manager. Of course. So, any question from the audience? Sure.
Yeah. Hi. It's Graham Johnson from the Bank of Canada. Brandon, a question for you. Are there net sales of savings bonds every year, or are there net redemptions? So is the outstanding shrinking or growing?
So on paper, it's net redemption.
And in total?
And just all
it's
separated.
It's mostly paper.
Yeah, it's almost entirely paper. So I think I mentioned, forget the number, $12 billion. So of that, 10 billion was paper in terms of redemptions. In terms of net, paper is a net of like 8 or 9, or actually it's all net at this point. Electronic is slightly net positive. It's fluctuating, but it's slowly trending upward.
And I mean, do you have an idea of the sort of net or the implied subsidy? Because obviously you're paying more. I mean, particularly, I have to admit, I was surprised at the double E bond that guarantees, if held to 20 years, 3.5%. I suspect there's a good thing you have a $10,000 limit on that, or it could be very popular. Do you have an idea of sort of the implied subsidy?
I don't have anything to provide in terms of numbers, but the rates are quite low compared to the marketable equivalent. So the 30-year Series double E is 0.1%, whereas the 30-year bond is 2.5%. So that difference in a way accounts for a lot of the cost that it takes to run that program.
I mean, but the 30 years 0.1%, assuming it's redeemed prior to 20 years. So.
Yeah, I'm thinking hold to maturity from that perspective. So there is that thought that the lower rate is going to take into account things like you have the option to redeem early, and you have there's sort of financial features built into that.
Thanks.
In India, we have been trying with several retail products. One thing which I am getting is that it has to be incentivized. You cannot sell the retail product at the same price as the marketable products. One is that the cost of borrowing for these products have to be different, and these will be a separate set of products. The second, what we have observed, that we have to give liquidity to the retail participants. So either like what the my Brazilian friend said that every year it can be you buy back. Every day, yes. Every day, in fact. Every day. So similarly, I don't know, since for Hungary and for US, it's just 1% of the total outstanding debt. So maybe I don't see much problem there. But in case of Hungary, when they're out of the total public debt, it is almost 25%. So how do you ensure liquidity or assurance to the retail participants that whenever they want, they can get back and take their money back?
Sorry if I was not informative here, but generally there is a secondary market basically. So that in the Treasury there is also a daily price. Simply the net price is not 100 but 98%. And then there is the accrued interest. So you can, any day, you can sell it to the Treasury with a 2% penalty. For banks, it's different. They can apply their own price. So for banks, we are allowed to actually, maybe they can be very competitive and so on. But so far, yeah, that's, yeah. So there is a daily price for in Hungary as well. This is a little bit the challenge, is that if we change the coupon of a new bond for a higher one, you know, then if we allow a very good price for selling the old bonds, then everybody would sell the old bonds and we would just buy the new ones. And this is why we apply this 2% penalty.
Share one experience in India. Like to have these retail bonds, we have recently issued gold bonds. Okay, these gold bonds we are issuing at a price of the previous 7 days average daily price of gold, and it's a 8-year bond. At the time of maturity, we repay at that particular rate, whatever the rate of the gold is at the time of redemption. But over and above it, we are paying a 2.75% per annum interest on these bonds. Now, we were thinking of giving a liquidity or buying back the central bank buying back those securities. But the challenge which you just now mentioned is that if we give that option, whenever the price rises, everybody will come to us that they want to give back the bonds. So that is somehow we are not able to solve that, and we are not able to provide liquidity. But instead, what we have done, we have added a secondary market. We have allowed it to trade on exchanges, so that anyone wanting to have these bonds, they can trade on those exchanges. That have been allowed.
Just in the case of Brazil, I mean, although the investor can sell to the Treasury on a daily basis, I mean, what we realize that most of investors are you know, they just hold the bonds until maturity. You know, although they have this kind of put option on the Treasury, they do not exercise it, at least for the great part of investors. But anyway, it is a risk, you know, and I mean, whenever it gets too large, I mean, you have to, ideally, I mean, what we are going to do, I mean, if we actually reaches, the size reaches this threshold or something like this, is kind of try to develop the secondary market for the Treasury direct bonds.
Not directly on your question, in France, we had an experience of issuing a government bond in the 70s, which price was linked to the price of gold. And it was just before a huge spike in the price of gold, and it was quite a challenge, and it's still in the memories of many people at the Ministry of Finance.
And may I ask that you cover that? So actually you buy gold?
Yeah,
preferred a gold reserve fund, wherein we are a portion of whatever we are receiving, it is a sinking fund which we have created so that if any uptick in the price at the time of redemption, to a large extent that reserve fund will take care of it.
Yeah, thank you. From Sierra Leone. I just want to know whether, because there is an overwhelming view that the prime objective of using this approach is to encourage savings, right? But then, from a low-income perspective, we have a very underdeveloped market, and of course, the level of savings is very low. Will this instrument thrive in terms of like using it also to raise finances for the Treasury, or is it primarily to encourage savings in the economy?
Just to your question is the purpose of the retail program between increasing the savings in the economy or providing a financing for the government. Is that correct?
Yeah.
For Thailand, we mobilize fund through saving bond to use for budget deficit also. So it means that those mobilized funds are for the purpose of government spending.
I could add to this. So yeah, we're certainly encouraging savings is a key function of the U.S. program. We would also add that financial confidence is another sort of part of our vision, and that kind of plays into the fact that the securities have these annual purchase limits of $10,000. You know, you can only get so much. A MyRA has a $15,000 cap of total purchases. The idea is that once you get to a certain level in terms of your savings, that you move on to the private sector. But to do that, you need to have some confidence in that you can save and you understand what you're doing.
So we have time for one last question.
Thanks. My question relates to the countries where the commercial banks are administering the retail program. And I wanted to get a sense as to whether or not the governments are paying them to undertake that role. And also, do you see any conflict of interest with respect to them administering the program, given that investors, the retail investors, would likely be moving monies from the commercial banks into the government program?
Well, actually, we were even asked to offer the 6 months bill, and because originally it was restricted and sold only in the Treasury network. It was a kind of special product to help the Treasury. But then banks came to us and they asked us to allow them to sell it to their customers, because bank deposit rates were 0.05%. Money market funds accordingly didn't perform, and they saw that the clients are taking out the money and leaving the bank, and they said that this is not good. So maybe not the best, but the not so bad situation is to keep the client, even if they have to sell government security for the client.
Yeah, I can add to that. So for the U.S., in the past, when we had the paper program in full swing, we would, we still do, but we did rely on the banks enormously, both for issuing paper savings bonds directly through the banks and also redeeming those securities. And we did pay a fee at that time for that service. Today, with the shift to electronic, we no longer pay the banks to provide the redemption service. There's no issuance of the redemption service, but they're still doing it as sort of a courtesy to their customers. So that's something that, you know, is to our benefit. But, you know, the idea here is that we want more electronic transactions, so we're encouraging people to convert their bonds to electronic. And so we use the commercial banks, but we don't pay them for the service currently.
I agree on your view. Most commercial banks in Thailand, they sell their product first and they sell treasury bill later.
So, being a big thank you to our speakers. It was a very interesting discussion. As always, many questions. So, if you have additional questions, please reach out to the speakers during lunchtime or later in the afternoon. One last information: we will probably reach out to you in the coming weeks with a short questionnaire on retail debt programs. And the idea is to use the information to publish a research on retail debt programs in the coming months. So please, if you could fill in the questionnaire, it would be greatly appreciated. The lunch will be served right now in the atrium, the same location as yesterday. Thank you very much.